We really, one of our biggest deals is like the second I hear it, I always go, who manages it? And they go, owner. I'm like, all right, send me the stuff. Right. Like, oh, this guy has two complexes, manages it himself, and the employees report to him. Yes, please send it over.
Yeah, perfect.
Because yeah, like this is great. So we really look for the management inefficiencies. It's a lot harder to onboard those because you have to, teach an old dog new tricks with the tenants. But that's just kind of our focus on the buy box and what we're looking for today.
What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. In this episode, I'm chatting with Brian Ferguson, who is a Texas-based multifamily investor, actually an investor in multiple different asset classes, as well as somebody who has flipped hundreds and hundreds of single-family homes. Obviously, in this episode, we're going to focus on the multifamily side of his career. And we get into a handful of topics in this episode, specifically around his business being vertically integrated, how they view hiring, how their buy box has changed over the years, and why they look for the deals that they look for. We also spend a little bit of time talking about the Texas multifamily market as well and doing kind of an analysis on the current state of multifamily in Texas, both in terms of where deals are trading comparatively to where they have post COVID. We talk about insurance, talk about a lot of stuff that I think is going to be interesting for both investors who are looking in Texas, but also investors who are investing, generally speaking, because I think a lot of these trends are going to be extrapolated over multiple different markets throughout the country, especially in the Southeast and Southwest. So I think this is just a great episode specifically for the operators out there that want to hear a really experienced multifamily investor and an experienced real estate investor fundamentally talk about how they've built their business, how they view hiring and firing and building a team, how they really prioritize leasing at the property level, and which certain roles they consolidate into back end functions instead of being on site. And I think this is going to just be a great listen for everybody who's actively investing in multifamily real estate. So if you do enjoy this episode, please leave the show a rating and review as it helps the show get noticed by more folks, which is obviously our goal. We're closing in on 300. We're getting pretty close. I think we're about 10 away. So if you've been a podcast listener that's learned anything throughout the years that we've been producing the show, please consider just leaving a quick rating and a review if you're really feeling generous with your time and help us get to that 300 mark. But without further ado, let's get to this episode with Brian Ferguson. All right, I'm here with Mr. Brian Ferguson. Brian, I just gave the audience a little bit of a primer on yourself and just gave a quick little recap of the show here. But why don't we start with your background from the horse's mouth here, so to speak? What were you doing before real estate? How'd you find the real estate business? And give us the high level on what you're working on today.
Okay, sure. So I've been in it for about 2 decades and I'm 39. So that tells you I've kind of been in it most of my adult life there. Prior to that, teenager, odd jobs. Then I was in motorcycle sales, moved into auto industry, moved into finance, kind of ran a finance team there. Did that for a while and then just started with some single family fix and flip as like a side gig. I went from doing 1 to 5 to 10 and then employer gave me an ultimatum like, hey, you can't have a full business and this. So jumped head first. That was 06, 07, ran straight into 2008. So not great timing. Ended up with a large single family portfolio over the years. We got into multifamily. I had about 150 single family. We 1031 those, bought more multi. Fast forward to today, we still have a single family investment division that does between 100, 200 transactions a year based on the year. And then our core focus right now is acquiring multifamily and kind of neighborhood sized retail shopping centers. We got about 1,000 multifamily under contract on some more and about 500,000 square feet in retail. So that's
Love
the
it.
very
And
high level.
you got your hands in a bunch of different things here. Usually we get some of the folks that come on here, they kind of preach a strategy that's more narrowly focused, or they talk about you got to pick your lane, stay in your lane, etc. Obviously, you guys have been exposed to a handful of different components of the real estate investing business. And I guess, why don't we start there in terms of how you dedicate and maybe allocate your time, or maybe what your organization looks like that allows you to flip single family homes, pursue multifamily opportunities, pursue strip center deals, which, granted, multifamily and strip centers, they're both fundamentally commercial real estate. We're valuing them the same way, et cetera, but obviously nuances to both the acquisition and management of those. And then obviously the single family world, doing 150 to a couple hundred deals a year is a really robust operation. So how has maybe your focus evolved over the years, and how have you built an organization just maybe conceptually at a high level to maintain deal flow and to keep your hands on top of these different verticals underneath the umbrella that is your business right now?
So first of all, I would 100% agree to pick your lane and stay with it. I didn't mention that we have a self-storage, we have a mobile home park. We're not buying any more of those. As soon as they're seasoned enough, we will sell those. So we very much had to pick that lane. We've gotten very strict on, yeah, we're looking at a building right now that we can convert to a retail center, but then we could also turn it for a quick flip. And the team kind of goes nuts. And we're like, whoa, 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 this is not in our buy box. What are you doing? So I agree that staying in your lane, but at a high level, it works. We operate on a system called EOS, and we got there a few years ago. And we focus on a team. I surround myself with a good team. I definitely have the approach now from, whether it's bringing in investors or who we hire, I make sure we hire the right people, the right team. Like we do personality tests, cog testing, Colby A and C on everyone we bring in. We make sure that the person doing the position is they get it, they want it, and they have the capacity for it. Since we've done that, we built it to a point to where right now, if we weren't acquiring anything, I would be here because I don't want to sit at home. My team does not need me to operate the existing portfolio or to do the single family, especially the single family stuff. They're so dialed in, it's insane. But even the management stuff, they just don't need me. We have the right people in place. We find people that we pay them well, they love what they do, and they have time, for their family and other things. So that's the high level piece of it. Now, before that, we were able to do it by we had really talented folks and we all just worked a ton, 80, 90 hours a week. But what you learn is that you're all working a bunch of hours and a lot of you are doing the same thing and they're wasteful hours. Where now we have 60% of the team we probably had 5 years ago, and we're managing and doing even more. So that's kind of how I manage it. The short answer is just with a really great team, but there's a lot of methodologies in putting that team in place so that you can focus on it.
Yeah, for sure. I think something that would be helpful to a lot of the folks listening, and I think many of the folks who are listening are investors who have done a handful of deals. Maybe they've just started raising capital. Maybe they're starting to transition from being I'm just a guy or gal doing deals and I'm a solo real estate investor who manages all aspects of the enterprise, acquisitions, asset management, transaction coordination, et cetera, to, okay, I'm doing a slightly higher volume, or we've got a number of investors and now I'm starting to get a little stretched. I want to start thinking about making a hire, or maybe I have an investor who's got like a part-time assistant or something like that. But again, their business is continuing to grow. Let's rewind however far back you'd like to go, and maybe you share kind of the context around the time frame, whether it was like, the year or the business size or what you were working on at the time. Is there a hire that really sticks out as one that you remember as, when I filled this role or when I brought somebody on to help with this particular type of work or this workload, that really freed me up, that really allowed me to take that next step and to continue building the business instead of working so hard in the business?
I don't know. I can narrow it down to just this one. I think that's the mentality. It used to be like, man, it was this one person, and now that we got them, we can go do this. I
Mm,
think kind of what I referenced a while ago and having the right framework. Yeah, you still need the good people, but it makes finding them, I'm not going to say easy, but identifying and putting people in the right spot. It's funny. I was just on a show before this and we were talking about something very similar. It's one of the attendees asked, when did you know to start making the first hire? And then when did you start know to make the second hire? And I'm not going to go back and I can go back and tell you how I did it. I'm going to go back. I would tell you though, how I would do it if I had to do it today.
perfect.
So I operate every quarter when we do our quarterly sessions. I operate on, like I use like a four square, like a quadrant, when it's how much impact does something have and how much effort does it take? And I align it on that four square, right? So whatever has the highest impact with the lowest effort, that's the first thing I do. That's how I organize my day. But then I also determine my value at the beginning of the year and I update it quarterly. So let's say I think my value is, and they can't be made up numbers, right? It's got to be your value that, your value on an annual basis, but you get down to like granular, like what is my hourly worth? And you have to be able to prove that out by saying, if I say I'm worth $100 an hour, can I go do something right now for an hour that generates $100 an hour? Okay. Now let's say you prove that out. Now I look at the task. Like I hate building slideshows. I'm speaking at conferences and doing stuff and I always have to have slideshows. I'm not good at it, A. And there's people that you can go find VAs that are really good at it for $15 an hour, right? Overseas, whatever it is. So why on earth would I ever build a spreadsheet that I can pay 15 bucks an hour if I've proved that I can go generate $100 an hour? So I use that methodology with everything. And that's how you determine when the next hire is, right? Like if you can hire someone to go view properties on the acquisition side and pay them, 25 bucks an hour and you can generate 100 or 200, well, then pay them to do that. So that is how I look at it today and how the framework we have built. I wouldn't say I did that in the beginning when we made the first hires, and it was quite a roller coaster of 15 years. We grew, but it was always ups and then downs, then losing people and bringing people. And now I'll say, I mean, we haven't had turnover in years. So,
hmm No, I think that's a great answer, right? I mean, I think it fundamentally comes down to, because I think it's interesting. I think it is a fairly straightforward process for many business owners, I think, in terms of valuing the tasks that they're spending their time on, or the work that they're spending their time on, in terms of the impact that it has in the business, and trying to roughly assign a value to it in terms of what you could go out there and hire in the marketplace. I also think there's an interesting dynamic in terms of what you enjoy doing and what you're really good at doing, and sometimes there's not congruency between those two, where maybe you really enjoy or you're really good at work that maybe makes a little bit more sense for you to hire, but it's work that fulfills you and that you really enjoy doing. I remember for me, like there was some of the first hires I was making, I felt like it had to be on kind of the simple prospecting side, because everybody online is telling you from an acquisition standpoint, hire someone virtually to cold call for you, hire someone virtually to kind of manage the top of your funnel from an acquisition standpoint. But I enjoyed it and felt like I was good at it, so I kept that. And it took me a while to give it up just because I enjoyed it, and then I realized I could manage somebody, and there's enjoyment in that as well. But trying to strike that balance between where you can hire to maximize your per dollar, or your what you're making per dollar on your time and where you're working in the business, but also trying to find what you don't enjoy, because that can also be something that is important to hire to, or hire for initially, as well, as it relates to, like, you just don't want to be spending time on stuff that you don't enjoy, like for example you with
sure.
PowerPoints, right? But I think it's interesting too in terms of what you mentioned as it relates to the focus of where you guys are looking for deals, right? You mentioned these handful of verticals. We're flipping houses, we're looking for shopping centers. You've done some other asset classes in the past. You're buying multifamily. What has been the process over the years of almost educating your investor base? And I don't really know if that's the right terminology for it, but I feel, at least in our experience, we've had some difficulties over the years where very narrowly focused on buying multifamily within an hour of Boston, right? Our core market. We went out of state back in 2020, 2021 to buy some out of state deals, like a lot of folks did who were in the Northeast. Most of those deals went really well. Still own one, TBD on how that's going to wrap up, but it is going well so far. But it was always a process of, okay, now we're going to go buy, we have multifamily experience. We're not going to go buy multifamily in this market. And I suspect if we were to go and take a deal in a different asset class to our investors, we're now the multifamily guys who are, even if it's the same market, trying to raise capital for a deal in a different asset class. I don't know if that was a challenge that you guys faced, or if that was something that you had to work through when you started doing deals maybe outside of the deals that your investors had become accustomed to participating in. And if not, maybe this is a moot point or a pointless question, but if so, was that something that you worked through, and how did you work through that process?
Yeah, I mean, the thing is, like, outside capitals happened for a handful of years. So 15, 16 years were bootstrap 1031. We didn't bring in outside capital. So I don't want to say an advantage. I had a little bit of an advantage there because we had years and years of operational experience. The downfall is you have 15 years and people go, what full cycle in 15 years? Well, we're a
Mm,
holding. Like we don't buy to sell, we buy to hold. I'm very transparent with that. Like, you're going to be with us for a long, some of our deals we have, but so that's a little tough. And we actually we raised first, even though we had more we raised first on a shopping center because I put a deal together with just some people we knew that were looking to park some capital. And then they referred some people, and it evolved into this. Now we're 506C, we're advertising, we take in retail investors plus some family office stuff. So it's evolved over that. So I don't know if I answer that the best way. We had experience in both classes when we started, so I can speak well to
gotcha.
both. So
Yeah, and maybe another way of putting this is when you're going out there and maybe building the top of your funnel, how do you best position your business as a business that is buying in multiple different asset classes? And maybe this is just again, a very simplistic question in that you're seeking investors who are looking for fundamentally similar goals. blend of cash, maybe a blend of appreciation, and you have different investment vehicles to align with that. I just think it's interesting in that there are many investors where I think a lot of LPs right now, especially over the last couple of years, where a lot of deals have not gone well for many LPs, Southeast, Southwest deals, getting into floating rate multi stuff that, has not gone according to original underwriting projections for a lot of folks who have done deals in 21 and 22. And now they're trying to, at least in many of the LPs I speak with, invest with more kind of narrowly focused operators, et cetera. Not to say that there's not plenty of organizations that have multiple different focuses that do really well. Has that been something you've thought about on the messaging side when going out there and raising capital and meeting new investors, and or maybe you're just finding investors that more specifically align with a segment of what you guys are looking for from a buy box standpoint?
Um, yeah, so actually, interesting enough, like when I bring up the retail perspective for someone that's been in multi because of the history, they're like, that's interesting. I don't have any retail in there. It's all been multi. But then you flip the script and the deal that we hadn't had a deal in a while, and the deal we just put under contract is multi. So I tell them up front, they're like, again, like as much as people say be dialed in, I preach that too. And I'm like, look, this is our buy box. It's these two asset classes. And it's not just anywhere either, right? Like I'm dialed in on what I can give you the whole buy box on exactly what type of center I'll
Let's
buy
do
and
it.
exactly what
Yeah.
multi I buy. So we're dialed in on that. And I won't just buy them in any market. But it doesn't matter if I'm buying a $10 million shopping center or a $10 million multi or whatever that is. I still look at the same metrics. I'm still tracking. There's still certain returns I'm looking for, and we're chasing like heavy cash flow. And we more so chase assets to where our value is added by operational inefficiencies, not necessarily construction. So it's the same factor. Like I'm going to say, oh, this is a 2.5x, 10% cash on cash, whatever by year two. Like if that's what I'm chasing, I apply it to the same principles there. So I see your point. I guess I do okay with it again. I guess just because we've had so many years in the business, maybe, but I haven't seen that as a big hurdle. Not, it could have been a hurdle that someone hasn't told me though as well, right? Like we have plenty of people on the portal that haven't invested. So
No, fair enough. I mean, I think it's just, it's a question that, I shouldn't say a question, but a challenge we've run into as we've expanded our focus over the years. But differently than you, we started raising capital with one very specific focus instead of, as you mentioned, your organization had experience in multiple different asset classes with your own capital, 1031ing over a very long period of time. So the track record was already there in a lot of respects, right? So I think it's a little bit of a different scenario.
yeah.
Now, to speak specifically about multifamily, I think it'd be great if you could share your buy box and specifically maybe share how that's evolved over the years, because I always find that interesting in terms of maybe what you were buying in the beginning. Maybe it's the same, but what you were buying in the beginning when you started buying multifamily, and maybe how that's evolved as you've done more and more deals within the multifamily specific asset class, maybe as a result of what you've learned or what you find is the opportunity nowadays.
Yeah, so it did evolve from the single to the duplex to the quads. And then it got into like, I think it's probably '09, '08. I think we got into like 16 plex, a 21 plex, and then a 30, and then some 40s. And then that's where it grew from there. And then shortly after that, we grabbed our first, it was 134 unit. And then once we tasted that 134 unit and saw the efficiencies of that, that's where multi went from us. And I still actually have some of the old quad and duplex portfolio just because we've gone through these cycles and just haven't found the right time. A lot of reasons for it that we haven't gotten rid of all of them yet, but we've gotten rid of a good portion. But that's what evolved us into it. And that was all in the Victoria market. And then now, our buy box now it's pretty, so Victoria is a 60,000 city, 90,000 county population, about 150,000 MSA. So we target markets similar to that. Our management style, our advertising style, like little things like, for instance, apartments.com is super expensive for our area. We get very little leads out of it. We get phenomenal leads just having property managers post on Marketplace on Facebook, right?
Hmm.
Go to, Austin, that's not going to be the case, right? Like it's so the way we're trained to do it, and that's kind of where we get into like stay in your lane. We know our lane. So we'll do some C class. We really like that, that B class is probably our favorite, or C, we can get to a B or a B that's teetering on an A class. But we like markets our size, really something that it has to be able to support on-site staff. That's a number one for us. Like, people go, would you look at a 50 unit or 150 unit? I don't know. I mean, if you found a 50 unit that somehow was this unicorn and could support the full on-site staff, great. And then we also look for, if my model says that I got to go in and put a bunch of backsplash in or paint the walls and up the rents, increase the NOI so it has this big exit in 5 year or whatever. And that if most of the return, like you'll note on our deals, we tell our investors, you won't see to where like most of your returns coming from the exit. Like it just doesn't work that way because we're focused on stuff that we can get the cash flow, but we always say we're willing to work for the cash flow too. So I'm not looking to just, oh, I bought it for half price because the husband died or something like that.
Yeah.
We really, one of our biggest deals is like the second I hear, I always go, who manages it? And they go, owner. I'm like, all right, send me the stuff. Right. Like, oh, this guy has two complexes, manages it himself, and the employees report to him. Yes, please send it over.
Yeah, perfect.
Because yeah, like this is great. So we really look for the management inefficiencies. Now that makes a little bit of a struggle onboarding them. I will say it's a lot harder to onboard those because you have to, teach an old dog new tricks with the tenants. But that's just kind of our focus on the buy box and what we're looking for today.
Yep. Now, you mentioned you're looking for deals where a lot of the value is coming through operational improvements or operational inefficiencies when you buy. And, I would assume the biggest lever, right, for any of these types of value add deals is we got rents that are lagging below market, loss to lease being the term that a broker is going to use when he's marketing a deal and working to bring those rents closer to market in, a short period of time post closing or as quickly as reasonably can be done. Are there other go-to strategies outside of maybe just bringing rents to market that you're typically leveraging when you actually go out there and improve the operations at an asset level, whether it's maybe some ancillary fees or some unique tech or software or amenities that you're offering tenants or something outside of that you feel is like a go-to in your market that you feel has been driving a lot of value in the deals that you do?
Yeah, I think there's a few points, and you'll learn with us, like, or a lot of people go like, oh, where's the big lever we can turn, right? I'm a firm believer, even like taxes went up 50 grand, you can recoup the 50 grand NOI $25 at a time. It just takes more work and operation and
Hmm.
beats skill in operation. But we look for multiple things like, rubs is a big one, right? A lot of people will be like, oh, it has the rubs on there, but dive deeper into that rub section. Are they using a third party that's feeing them to death, right? Whereas our property management system completely allows us to pro rata and do it without, and our team's trained to do it. So I don't have to pay all these fees. So that's an add-on. Taxes and insurance, those are obvious, sums within control. Staffing is a huge one, right? Like I have a completely different belief, not completely different, but I definitely vary in staffing beliefs. We have a large enough property management company that like we need the on-site person to be good at meeting people, taking care of their needs and leasing, right? We have a big enough back end, and a lot of your larger companies, are doing it the same way now. Like you have your support staff, let them support them in, typing leases, a lot of these little random things, not saying they won't do it on site, but you have the support. So like if you have 10 complexes and every one of those has an assistant on it making 45,000 bucks a year, right? That's $450,000. Could you have two people at 90,000 sitting at a corporate office support all 10? Yeah, you can if that's all they do and they're not getting interrupted. Well, you just save 360,000 bucks across, divide by 10, 36,000 of property. So there's a lot of, I just think, efficiencies. And now if you're just buying your first complex, are you going to be able to find those same efficiencies? No, maybe not. But, another good point there, like, do you need that second person at 45 or 50,000 bucks on site, or could you get a VA to handle a bunch of that stuff that costs you a fraction of that? So we look for efficiencies in that because, I mean, you're in the space. If I can go plug in, say it's a $10 million deal, or let's say it's a $400,000 NOI, if on an annual basis, if I can go add 30,000 to that, like, I mean, that's huge.
Hmm.
So we look at all, or like who's cutting the grass, right? Oh, well, Jim's lawn company cuts the grass and it's 3 grand a month. Well, when's the last time that was shopped? So we really
Hmm.
get micro piece by piece, and then of course all your standard stuff like, are we charging for, premium views of the pool? What's the laundry service contract? Is there a fiber contract? I mean, I think everyone does all that stuff. I think where we try to be a little bit better is just getting into the micro pieces of each budget line.
Yeah, no, I think what you mentioned about, I mean, and you're in a position where you have this efficiency to consolidate some of the more, specific functions within the business that can be done not on site, right? And counting's a big one, and supporting the on-site staff, another big one, marketing. And you don't have to be on site to be helping with the marketing side and the leasing side specific to maybe posting units, right? Stuff like that. And I think that makes it really easy to hire an on-site individual who's great people person who's great at leasing because that's a sales function within the business. And I think a lot of multifamily investors like realize, I don't want to say too late, but just realize it takes them longer to realize than maybe it should, that like leasing is really, at least in my opinion, probably the most critical function of successful property management. Like you got to manage the revenue at an extremely diligent level because increases in revenue are typically dropping straight down to that NOI line because all of your expenses are basically fixed outside of some that are variable on a multifamily P&L. So in the weeds question for you because it interests me, and I'm sure there's some folks out there that might be interested in this. What are some, you mentioned you do disc testing, cog testing, et cetera, when hiring within your organization, but is there anything above and beyond that that you're either testing for or that you're looking for in a resume or from an experience standpoint with somebody on site that maybe tells you that they're going to be someone who's going to really effectively sell and lease and also be a great, ambassador for the property just being on site?
So yeah, I mean, the knowing if they have the like the so like GWC, we say like, do you get it? Want it, have the capacity, right? That get it piece of it, that's hard because they'll tell you they get it. That means nothing. I think a lot of the testing can help you with that. Some basic things on the resume, like right, like I look for tenure. Does that mean did you spend 4 years at a degree, 4 years at your previous job, 4 years in the military, whatever? Like, have you proven that you're going to stay somewhere? Because we want long term. And then just organizationally, like we developed our core values and we hire and fire based on our core values. So you can be the absolute best rock star leasing agent, property manager in the world, but you don't meet our core values, we're out, right? I'd rather work with someone with a slightly less skill set that meets our core values. For us, that's they're the ones that'll kill for you. They're the ones that care, and it just goes a lot further. So, but I think the testing piece is big and it's not even hard to do nowadays, but I think to make sure that they're the right fit for it, that's really important. But to your point, like, yeah, the leasing piece, like it is sales, right? Like you're going to get someone in there and go, oh, well, they're really great at sales. And then you're mad at them that they can't like make these master spreadsheets. Right. And then the other side, like one thing you mentioned a while ago that resonated is I feel like everyone focuses on that top line. Like, can I get rents from 9 to 950, 950 to 1,000? That's great, but now your expenses are 70% of that. Like, are you focusing on the expense side? I'm not saying save yourself into a profit, but they both, obviously both matter. And I definitely think that gets missed. I mean, I'm in some deals now to where they got the rents where they said, but we're getting killed on expenses at like 65, 68%. And we had to replace the sponsor for multiple reasons, but he just wasn't paying attention to the property. So, yeah.
Hmm. Yeah, and it's tough because, when you look at the P&L, right, you can obviously optimize either side, whether it's revenue or expenses, right? You can grow revenue, you can cut expenses. I think a lot of people just overlook the cutting of the expense side specifically because it, you know, it's a little bit easier to focus on leasing, right? Usually
Sure.
that's what's right in front of you, what you got to solve for right away. But if you have the leasing side well developed within your organization where you have great leasing agents, you have a great leasing process, you're advertising in the right areas, you're renewing more residents, so you just have to do less leasing, right? Like you're not turning over units as frequently as maybe other folks are in your market, then it frees you up to more diligently manage the expense side too, just from like a bandwidth standpoint, and to shop those landscaping contracts, the plowing contracts, for us up here in the Northeast, common area cleaning, whatever it might be. I think a lot of people, it just becomes an afterthought because they're so worried about putting out fires on the leasing side of the property because it's not going well, right? And I think, one thing almost leads to the opportunity to focus on the other. At least that's been our experience in our business.
Sure.
Obviously, there's benefits of vertical integration within the properties or within your business as it relates to diligently managing both at the property management level, the asset management level, the buildings within your portfolio. But I know you mentioned that you have some third-party managers managing some assets that are a little bit outside of the core market. What does having your management infrastructure in-house allow you to do from an effective asset management standpoint when overseeing the projects that are being managed by third parties? And maybe talk about a little bit, just at a high level, your process in really holding your third-party PMs accountable, given that technically they're not within your organization itself.
Sure. So one, the way we pick that is we just say who is the absolute best option to manage the asset. If that's us, great. If it's in a market that's 2 hours from here and there's just a rock star company there, like great, then we're going to let them do it. But definitely having the management experience really helps us on the asset management side, right? Like you send us bills and go, oh, this is going to cost 10,000 bucks to reroute this line. Well, we know we just rerouted one for 5,000. And don't get me wrong, you could have that same experience just from managing assets for a long time because you paid the bills. But like having those boots on the ground, seeing what the trends are, or them saying, let's say occupancy is down and it's not in your core market, so third parties managing it, and they go, oh, and you see where they're spending the money on marketing and nothing's working, but we transitioned and had to do XYZ on our property over here. And we don't go like, oh, why aren't you doing this? We just we bring that up. Hey, have you tried this? And we don't end up having to do that a whole lot because we vet the third parties quite a bit. Like we're buying shopping centers in Katy, Texas, right? Like it's 90 minutes from us, but could we handle the property management piece and reconcile triple nets? Yeah, all day long. But in that space, it's very different because you have to have a leasing person. Well, we're not there to lease. They were better at leasing. So it's simple. Like it's a simple answer. Just let them do it. But I don't know. I think that it's tough because I almost kind of, especially someone just starting out, like if they buy a property, like if they can be more involved in the management piece without stepping on a third party management thing, I think they'll be better for it. But like if you buy a 20 unit property, like maybe get some feedback and do the management for a little while. I don't know. I've always been torn on that. Like, it's like you don't want to set
Yeah.
someone up for failure if they're not good at it and someone's better. But at the same time, when young people ask me, I don't know where to get started. I only got like 6,000 bucks. I tell them, go get an FHA loan and buy a fourplex and be the manager
Yeah.
and the maintenance guy or gal, right? Like, I don't know how much better experience you can get to see if this is what's, right for you in life.
Yeah, no, 100%. And I go back and forth on it because I think there's a lot of folks, and I can't knock them for having this opinion that says you should manage that first deal that you buy so that you get your hands dirty and you understand the scope of what's involved with property management. I personally tend to believe that, especially if you're coming from a place of I don't have like a construction background, I have no background in property management, I have no background in real estate, I have no background in the trades. And it's like, okay, well, it's actually more likely that assuming this is a good PM we're talking about, not a crappy one, but like the
Yeah.
good PM in your market is probably just going to do a better job of managing this 5, 10, 15, 20 unit building than you are because they know they know the rental rates, they have all the vendors, maybe they got their maintenance guys in house and they got great GCs and vendors they work with that give them good pricing because they give them all this business. Yeah, you're going to pay them a management fee. You're not going to be as involved in the front lines as you otherwise would. But again, assuming that you're hiring the right management company, they're probably going to do a better job of managing the asset than you would if just on your first deal. Now, as you described, like a small building where you're living there through an FHA your owner occupying, that's a whole nother ballgame because like you're always going to do a better job of managing a property that you live at than a PM
Yeah.
would. I mean, very strong opinion on that. But I find it interesting though, because I think a lot of the folks that preach you should manage your first regardless of if there's a good PM in your market, maybe come from a background where they have like, they know that flooring should cost, I don't know, a few bucks a square foot. Whereas somebody who's like 22 and out of college and buys a deal, they may have no idea what any of that stuff's supposed to cost. And they're
Yeah.
kind of lining themselves up to get taken advantage of, which I think is challenging. Now, that begs the question, which sparks an idea. Is construction also something that you have under your umbrella as well, or is it strictly the management function and you're going out there and working with GCs to
No,
help
we have
renovate
we
units and
have
all that?
construction and we treat it the same way. Most of the time, our construction leg's only involved if our property management leg's involved. They kind of go hand in hand if we're third partying this out, especially in some of the like the market's been on the proximity to a bigger town, because we're 2 hours away. Again, it's if we're the best option. Like I get third party bids. If our construction, I have no problem telling our construction company, look, you weren't the best option. You weren't the best price for it. To your point, though, like I still think that even if they go, oh, this guy knows that he has a construction background, he knows this. To your point on those efficiencies, though, like is he going to be able to get the flooring for $1.50 that they can get, or is he going to pay $2.50? And you maybe just being upfront and going, hey, look, I just bought an 80 unit deal. I want you to manage it, but I'm also trying to learn. I'd like to be a little bit more just being transparent with them. Now, there are some third party companies we've interviewed them in certain markets. They're like, hey, we want to like, look, we get y'all are in the business and you have a management company. We're telling you right now, if you plan on being over there, we're the wrong person for you. If you have a question, you'll ask a senior. You will never talk to anyone at the property level. So that may not be the right one. But if there's a rock star third party company and they're like, yeah, don't be annoying, but we'll teach you. I don't know. I'm very much on the fence because I mean, the deal we're buying right now it was his first deal and he managed it himself and it did not go well. So
Yeah.
I think there's times where that's just not the case.
Well, I tend to agree. I guess there's probably no right answer because you find one person on both sides saying, I did this and it worked really well for me, right? I know for me, like I self-managed to start, but I didn't know anything about construction. And I would have just been way better off hiring a third party and having them bid out the unit turns and the roof and this and that because I had no frame of reference at all of which to compare, this quote to that. Even if I'm getting multiple quotes, I all three of them could have been high. I wouldn't have been able to tell, right? And I think that's a real risk for an inexperienced new investor. Our in-house management company, we do some third party as well. About half of our portfolio is third party. And the amount of times we bring in a smaller deal, like something that's 10, 15 units, whether it's a building or a portfolio from a owner manager, and we're like, your rents are just 20% below, and they have been for years, and you've thought they were at market, right? It's like there's a lot
Yeah.
of those conversations where it's tough because they just don't have the frame of reference or the access to the data that we would have, right? In managing,
Sure.
900 apartments in a smaller area. We don't have construction in-house, so I'm going to kind of stay on this for just a couple seconds because I find
Sure.
this interesting. Is that something that you grew in tandem when you started bringing management in-house, or did you grow your management arm, regionals, on-site PMs, leasing agents, et cetera, back office staff, and then you brought construction in-house, or was it all kind of in tandem as you grew the in-house operation together?
Yeah, so I mean, keep in mind you go back 2 decades and we started out in fix and flip, right? So fix and
That's
flip
true.
created a construction superintendent, and
Yeah.
then we did land development. And at one point we were doing 50, 60 custom single families a year, ground up. So we had that department and then it just merged. We were managing maintenance our own rentals. And then we did now, as the management piece got bigger and the portfolio got bigger, we had the people, but then we actually created the construction company. And that was in tandem to come and service the property management team. They're just shared services, right? And so it works out for us. It has a dedicated superintendent, but they share some services and this company only pays for the services as needed. So it works out a little bit better. But yeah, no, we kind of cheated in that aspect because we
Yeah.
had tons of construction experience.
Now that certainly makes it much easier having especially a single family house flip is obviously going to be a bigger budget than an apartment turn too, so that's probably something you have to do pretty quickly in order to keep your arms around that whole animal.
For sure.
What do you think is just out of interest in kind of filling the roles within your organization, whether it's on the PM side, the construction side, or elsewhere? I'm sure you're making recurring hires for different roles as you grow the portfolio and as you bring more people into the business. What are some of the roles that you're finding take a little bit more work to hire the right person for right now, or a little bit more taxing from an HR personnel turnover side within the business than others?
Unless we're onboarding something, we haven't had to hire a whole bunch. We actually, in the past few years, because of some of like the single family stuff slowing down, we actually decreased our team and then
Mm,
increased it on the property management side. But when we onboard, like if someone's been there a decent amount of time, we try to give the on-site a chance. We really
gotcha.
do. And so we'll bring them on that way. But but even that piece of it, just finding someone, because on the property management side, like we talked about, like if you're going to be on site, like it's a whole different world, right? Like someone comes and goes, oh, well, I worked at Dillard's or the 7-Eleven or whatever it is. It's different. Like you got to deal with people. You're going to have upset people. You got to be a salesperson. You got to smile. You don't have to be an accountant, but you still have to understand numbers. And then you got to manage the maintenance guy. And like it's a whole different world. So I would say that one's a little bit of a struggle to find. I think all of our hires are pretty, just because of how in depth we've got on all the personality testing and all that, all of them seem to be, I'm not going to say hard, but they're a process. I'll put it that way.
Yeah.
There's not just like we post an app, three people came in. Oh, I really like Jane. We're going to hire Jane. Because what we'll do is we'll be like, man, I really like this person. And then you get all the data back and you're like, they're going to kind of struggle here. And then the times that we've made the exception, you go, let's say it's a property, you go put them on, like we onboarded one and we kept this person. I'm not giving you specific. We kept the person. We did the testing and the testing said no, but they had years of experience doing it, right? And so we're like, oh, I mean, the test, you can't always live by the test, right? Because
Yeah.
they'll tell you when you start down this process, like, don't go into your company and then your sales manager who's been like killing it for 10 years, and you're like, oh, they don't have sorry, man, sorry, you got to go. Don't do that. And so we kind of took that approach and we onboarded and we saw all the weaknesses, right? And then as the property started to struggle when we were, raising the rents, 40, 50% on some of these people, they could not handle it. And you go back to the testing, and it was pinpointed right there that the confrontation piece of it, like when the going was good, they were great, but they could not handle the other piece of it. And that's probably why the property struggled, So I think when you really get in depth in it, like the whole slow to hire, fast to fire, not saying go fire everyone, but there is some meaning in that.
No, for sure. All right, to round this out, let's quickly chat about the Texas multifamily market. Again, I'm up in Boston, I'm in New England,
Sure.
right? I have a vague understanding of what's going on in the kind of like the major metros, right? You got all this new supply hitting Austin and, maybe Dallas probably to a lesser extent, rents maybe flatlining coming down. You got insurance problems in Houston. That's kind of or not insurance problems, but rapidly rising insurance expenses. Don't know too much about the Victoria market, but maybe talk about how it's evolved over the last, call it, few years. I would imagine that you've probably seen much more out of state interest, even though it's more of a tertiary market comparatively to some of those core metros post COVID. That would just be my assumption from afar. Correct me if I'm wrong. What does the market look like right now in terms of have cap rates kind of bottomed out? Have you felt like they're starting to rebound? Have you seen the market change significantly? Let's call it in 2025. Us recording this conversation in early May here. Maybe just your broad high level commentary on what you're seeing locally in Texas right now.
So we are a smaller market. We're going to be looking at your secondary, tertiary market. So I can give you about the same thing you said as far as some of the bigger markets, Austin, Dallas, Houston. Insurance has definitely been a big struggle. That has actually gotten better. We actually, towards the end of the year, saw some reductions on renewals. So I'm not saying it's back to where it was, but we've seen a little bit of relief there. That's been helpful. I think everyone knows of that struggle, though. In the markets that we're in, so we're definitely in a supply restrained market. So it is a little bit different of an approach because when you have the supply restraints, what you can do with C and B class over the years, knowing that lack of supply will still be there in the next 2 to 5 years, I think changes the landscape of that. What's interesting in our market and some of the other smaller markets that we look at, there's a decent amount of out of state ownership. Like, I mean, there's multiple groups from New York that own stuff in Victoria, Texas, right? So they've been, I think, I'd have to go look at ownership. I think a lot of it is in that 19-20 range when they were buying it and now starting to sell it off. I will say, I was at a conference this weekend and they're saying, it's going to be 26 to 27 before we start seeing, sellers' real expectations align on a graph with, where the market is. I think maybe 26, 27, you're going to see that across the board more, but I don't think waiting till then is the aspect. And the fact that we're under contract, one of the best deals we've seen tells you that. But you're going to have to find the right brokers. But there's definitely people, I think what we're seeing, and I don't know if this is just Texas, but other markets, like some of like if you have agency debt and you weren't meeting some of the smaller requirements, inspection requirements, they were letting that slide for the past few years. And
Mm-hmm.
now they're already saying no. Like no, like the deal we bought, like he was facing foreclosure because he didn't comply with an inspection. Like they did inspection, he didn't do the list, put his head in the sand, and they were foreclosing on him. So I'm not saying like we're still in this year. I've talked to a lot of people who are holding on. And if they're in a position where they can hold on and wait for rates, I think they're going to do it. But there's definitely already an approach of some that can't. We see in our markets, we were seeing like if you had said a year ago you wanted to see almost an 8 cap to touch anything. And I was talking to a guy that owns some properties here. Has brokers telling him he'll be able to sell it at a 6.5, which is that'd be interesting
Yeah,
for the market. It does. So
that's certainly better. Certainly a
yeah.
rebound. Yeah.
Yeah.
And this is purely anecdotal. I'm not a Texas investor, so it's all just a massive grain of salt. But, in my conversations with some folks that I have in my personal network who are heavily invested in Texas and are continually buying in Texas, specifically in Dallas and Houston, a couple of folks I know, they've kind of echoed that last comment you just made where they basically saw cap rates max out about, I don't know, late 2023 into early 2024, kind of mid 2024. But now they're starting to see cap rates start to compress again, starting to see deals trade, that may have traded at a 7.75, 8 cap, as you mentioned, now trading the low sevens, high sixes. And that's just specific to the C class deals they're chasing. And again, for everyone listening, this is just me recapping conversations, but it seems as if that is a dynamic that is occurring. I mean, and even local to our market in the Northeast, which similar trait to it sounds like Victoria is a very supply constrained market, not a lot of new development. It's really hard to build. It's expensive to build, and there's not a lot of land to build. And, we saw rents stay relatively strong in the sense that we didn't see any rent decline. If anything, we just saw rents flatline / marginal growth. But I think that was primarily due to less people moving, fewer new household formation. So people were just staying put and there was less people moving around. Therefore, there's less demand on the housing side.
Yeah.
And we're starting to see that start to come back a little bit now, just in terms of our leasing data. Now, broadly speaking, I think that the challenge that we're seeing is it's really hard to find that balance of where different markets are starting to meet that equilibrium of where buyers want to be, right? And I think that's where a lot of people are kind of sitting on their hands, is they don't really know if the knife is going to continue to fall or when we're going to see a rebound or when rates are going to move. But as you mentioned, it's more opportunity for the people that are staying active and diligently underwriting deals and have a lot of in-place data with other properties that they otherwise, that they own or otherwise manage, to go out there and make some informed decisions in the short term if it makes sense to do so, which it seems like is the exact position that you guys are in.
Yeah, I mean, I think the last piece, that's a really good point. There's people that are definitely capable, but like if your time is completely consumed, kind of putting out fires with your current portfolio, it's kind of hard to focus on finding the deals. And to your point, yeah, I mean, I think like that was the guy I talked about. Yeah, he's going to list at 6.5. He wouldn't have done that a year and a half ago. But that doesn't mean there's not still deals that are out there at 7.5 and 8. You just have to find them because they haven't done
Yeah.
the things needed to make it to where it can retrade at 6.5. And so there's still that opportunity to grab it at a 7.5, 8, or I'm not really just a pure cap rate focused guy, but that's what we're talking about. And then
Yep.
you can retrade it later or sell it or whatever. So again, I'm not saying that they're knocking on the door, but I think the off market deals are there, whether it's broker relations or direct contact. So just got to work a little bit to find them.
Absolutely. Well, Brian, this has been great. We'll get you out of here. Where can people find out more about you and then obviously what you guys are working on?
So our website's fergmarcapital.com. That's FERGMAR capital.com. You can book a call, see what we're working on. Always happy to hop on calls. Love jumping on calls and talking with folks. So,
Love it. Yeah, we'll link that in the show notes. Brian, thanks again for making the time, man. This was great.
all right, man. Thank you.